Hi, this is Tim Kelly from Breakthrough Insurance Group, and welcome to The Big Idea. As we continue our discussion this week about the benefits of permanent life insurance, I'd like to discuss with you a sales concept called pension maximization. Now, this works really well for clients with defined benefit plans or pensions. And I'm going to review with you a white paper we put together here at Big on this concept. I'll also attach this white paper to the newsletter that the Big Idea is in for this week. Now, the idea behind this concept is to allow the retiree to take the highest pension payout and use life insurance for the spouse for their income, as opposed to taking some survivorship income benefit in the pension. Now, pensions differ by state, so just realize that these are general guidelines here that I'm giving you. Your rules may be different in your state. So generally, they're going to have 3 or 4 different payout options in the pension, one of which is the life-only income option that you see here as number 1. And that's the highest payout option for the retiree because it won't offer any survivorship benefits. Then you'll usually have a joint option that pays 50% to the survivor, and also another option that pays 100% to the survivor. That pays the least income because it's based on both of their life expectancies. So as we scroll down a little bit, let's take a look at an example of what this might look like. Now, in this example, we're looking at two 50-year-olds. Now, this is important because you want to try to get to your clients as early as possible to help them to plan for their pension. A lot of times what we see is you'll get a call from your client, they're age 60, and they call you and say, hey, I'm retiring in 3 months. Which pension option should I take? That is not the best case scenario for pension maximization. You want to get them earlier than that, sometime in their 50s, where the life insurance cost is actually less expensive. So in this situation, we've got two 50-year-olds. He is going to retire at 60. She's going to be 60 at that time as well, 10 years from now. And at age 60, his life expectancy is 24 years and hers is 27 years. Now, at retirement, he's going to have a choice of option 1, which is the life only for him, and the individual option, and that would be $5,000 per month in our example. And then option 3, which is the 100% survivor benefit, will be about $4,000 a month. So about $1,000 per month difference in these two choices. What we want to try to do is get them to pick option 1 because it's going to give them an extra $1,000 per month. And over his lifetime, if you just want to put that in perspective, over his 24 years of life expectancy in retirement, that would equate to $288,000. So that's a significant sum of money that you can offer to your clients by using this pension maximization concept. So the goal really here is, again, to pick the higher option, the $5,000 per month, and use life insurance to take care of the $4,000 a month that she would receive if he passes away. So let's take a look at what that might look like for a couple at the age of 50. So what we're going to do is we're going to see at age 60 when he retires, what amount of money is it going to take to fund $4,000 a month for her over her life expectancy. So putting that into a basic financial calculator, at a rate of return of 5%, that's going to require about $710,000 in a death benefit at age 60 to fund $4,000 a month for her 27 years of life expectancy. Now, as they age, they will need less and less life insurance to cover that $4,000 a month. So we can use some laddering tactics so that we don't have to buy all permanent life insurance. We can use some term insurance to keep this cost down. So as an example, at age 70, they're only going to need about 550,000, and at age 80, they're only going to need about 280,000 because her life expectancy at that point is only 7 years at age 80. So you're going to need less to fund that 4,000 a month. So how would we do this? We would look at permanent insurance. In this case, we're going to use guaranteed UL to age 105 for the amount that she'll need over age 80, which is 283,000. We're going to have that last forever for her, and that costs $229 a month. And then we're going to cover the difference with 30-year terms. So remember, they're buying this at 50, and that will take them up to age 80. She'll have 427,000 to make up the difference to get to the 710, and that 30-year term will also cost 145 for a total of $374 a month. Now remember, we're saving them $1,000 a month. He's taking the 5,000 pension instead of the 4,000. So we're saving him 1,000. He's going to take 374 of that to use to pay for the insurance. So we're saving him net over $600 per month. This works really, really well. And the final page of the white paper, you'll be able to take a look at this. We put all of the different scenarios on the left-hand side. If the spouse dies first, if the plan participant dies first, what if the plan participant dies before he even retires? How does that compare the joint 100% survivor to the pension max concept? And you will see how much better pension maximization is for the client as opposed to taking that lower pension amount. So thank you for joining us today. If you'd like more information about pension maximization, please feel free to reach out to your sales directors at Big here. That would be either Vic or Tony. And thank you for watching The Big Idea.